Thanks everyone for joining us on our fourth quarter review of fund performance. I'm Jeff Tjornehoj. We'll kick things off with a review of what happened over the year. It's kind of tough to review the fourth quarter without looking at a couple quarters back and giving you the full year perspective as well. So over the course of the year, the bond market was doing pretty well, with the 1 weak spot coming last quarter. I'm sorry, 2 quarters ago in Q3. Still showed a positive return then, but overall for the year, it's hard to argue with this kind of performance in the bond market. If you are an income investor, things look pretty good. There were some pockets of softness and concern, and we'll cover those in a few minutes. But I think I'll give you some background, my thoughts on why the market looked like this, looked so strong throughout the year. When we're looking at the Barclays U.S. aggregate, the key word here is U.S. This is not a global perspective. This is only what happened inside our borders. And we have a very strong case to be made for our economy. It's strong. It seems to be on a pretty solid footing right now. Certainly some areas of concern. There always are, but overall, I'd say people are tending to be more upbeat on our prospects than they are almost anywhere else in the world, which is quite different from our major trading partners. Europe, as Tom mentioned, is struggling. Certainly the crisis that came about with Russia invading parts of Ukraine, taking back Crimea and so forth during the year has not been resolved and still continues to worry people in Europe. We've put sanctions on Russia. Certainly oil prices have declined considerably, about 50% last year. That's really hurting Russia quite a bit as well. As Tom mentioned, Europe is also dealing with a potential Greek political crisis around the corner, as Syriza, a very leftist group, is considering that if they do win elections in Greece or win enough seats in the parliament, that they may retract some of the financial aid conditions that Greece accepted as part of its bailout. In Japan, things are also looking a little less hopeful. Abenomics, as a growth leader, a growth engine in Japan, is fading. He had a national sales tax rejected, and that's kind of put a crimp in his third arrow of rebuilding the Japanese economy. In China, growth is slowing. They're looking at about 7.3% GDP growth in 2014. There were people at the beginning of the year who thought that China was going to work its way back into double-digit growth rates, and in fact, it's coming in for a landing. And the question is, will it be engineered for a soft landing or a hard landing? And at this point, we just don't know. They ended up loosening monetary policy earlier in the quarter. That was a bit of a surprise to a lot of people. In emerging markets, as Tom also touched on, they're also slowing. Though in some areas, low oil prices are helping. India is a big example of one country who is strongly benefiting from lower oil prices because they are an energy importer. Brazil, on the other hand, can't seem to get its inflation under control. They also hitched their wagon to China a few years ago, and with China slowing and Brazil such a commodity-driven country, it's tough to see any improvement in the outlook for Brazil. And of course, that is such a huge economy in Latin America, it really weighed on prospects down there. So there's the backdrop. Things are looking good in the U.S. Things are a little more dicey elsewhere in the world. So let's take a look at how that translated into performance over the fourth quarter. The biggest plus side performance was turned in by general U.S. Treasury funds. We'll talk about that later. The worst was emerging markets local currency, and in between there, we tended to see mostly positive returns. I think the theme for this quarter is the U.S. dollar being very strong, hurting world income, and then concerns on a number of areas causing people to pull back on the risk reins and shift money out of riskier assets like high yield and loans. So let's take a look. Let's take a look at our first group to cover, and that's U.S. Treasury funds and TIPS funds, or what we call inflation-protected bond funds. This is the yield curve over the last at the end of last quarter, the end of third quarter, and the end of 2013. So the yield curve at the long end dropped considerably in December. You can see it's over a full point lower on the 30-year than it was a year ago. This is quite a shock to people who expected interest rates to climb in 2014. Part of the reason why we saw outflows for bond funds at the end of 2013, and then 2014 comes along, and no one had a clear view of what they should have done. Had they stuck to the plan, they probably would have enjoyed a very solid year, and hopefully they did that. So there's what the yield curve looked like over a number of points. And I think we can't ignore the effect that oil prices have had on Treasury yields. I think it's kind of an interesting reflexive movement here where is it the oil prices that are pointing out a recession, or is it concerns about a recession that are pushing down oil prices? I think you can make an argument both ways. What this is doing is causing, certainly the 10-year has been on a rally throughout the quarter, coinciding with a sharp pull down in oil prices. It'll be just a matter of time, I think, before we see $40 oil. And boy, what that could do to the 10-year, I think will almost certainly get below 2% here shortly. Jeff Gundlach came out with a bit of a forecast in Barron's a few weeks ago, and he thought that it's possible in 2015, the way things are currently going, that we could see the 10-year dip below its modern era low of 1.38%, and that was in 2012. I mean, that was just it quickly bounced back, but yeah, could you imagine the 10-year getting back below 1.4, even 1.5? So we have a little ways to go before it's that bad, but if oil prices continue to slide, I would expect that yields on Treasuries will rally even harder. So over the quarter, this is where each of the primary tenors drifted. As you can see, the 30-year started off the quarter with a good rally. It tended to level out at about 3% and then continued to plunge further as oil prices slid. The exceptional area here, if we look at the 2-year, it's that purple line right about, about 50 basis points. It too rallied at the beginning of the quarter till about mid-October, and then it became a proxy for concerns about the Fed raising rates at the short end. I think there's an expectation now that the Fed will raise, overnight lending rates probably around June or so. It could go a little bit later. Maybe it's more like September, October. But as a proxy to that, the 2-year saw rates go higher by a fair amount. Also, the 1-year and the 6-month also went higher on those expectations. So there's kind of a tug of war going on as traders try to anticipate when the Fed will raise rates. I expect them to solidify that 25 basis point standard. It could be in June. I think that's a reasonable expectation. I don't know that it's going to cause ripple effects throughout the rest of the bond market, though. Next groups to take a look at are some of the general domestic ones, specifically the corporate debt funds, A-rated, BBB. We'll also take a look at high yield and loan funds as well. So here's where the high yield, BBB, and A-rated indexes went. These are not the funds indexes, these are the bonds indexes. As you can see, it's Bank of America, Merrill Lynch, corporate debt total return. Quite a volatile ride for high yield since about mid-year. This is a full year view. The blue area on the right is what happened during the quarter. It was quite a choppy ride for all types. BBB tended to rise above the rest, as I think people still needed some income, but weren't quite willing to take as much high yield risk. So they were kind of working their way up the quality curve. I think we could expect in Q1 of this year that maybe A-rated starts to assert itself as being the target for a lot more investors. Spreads, though, were quite a bit different. Here you can see a real blowout from the high yield Master 2 option-adjusted spreads here, where by mid-year they were trending lower towards about 300 basis points, then immediately reversed on a dime had quite a few volatility spikes and ended the year closer to 500 basis points out. So investors are really reconsidering high yield in a way that they haven't in a long time. Even the triple B got in on the action a little bit. They rose slightly from a mid-year low of about 170 basis points to now about 200. It was pretty steady, as you can tell here. Not much change over the course of the year, even after oil prices started to slide. People aren't worried about AAA corporates right now. Loan funds, man, what a tough quarter they had. They started the year doing pretty well, and here we've got the one of the major benchmarks, the S&P LSTA Leveraged Loan Total Return Index, and that's the red line here, and then we have U.S. loan funds underneath it, our own proprietary index of loan mutual funds. Both took a very choppy ride into the end of the year, finishing lower than their mid-year high, and still actually coming out ahead. If we look at loan funds for the quarter, they ended up down about 68 basis points, which, kind of, as you can see here, kind of a choppy ride. For the year, though, they still ended up 57 basis points, so not too bad. And I probably should have covered off what high-yield funds did on that prior slide. They ended up for the quarter down 162 basis points and still managed a one-year return of 1%. So high yield, still positive, but lagged A-rated and triple B-rated, which were up over 7% each on the year. They were both up for the quarter about 160 to 190 basis points. So corporate debt still doing well on the investment grade side. Different story on the high yield side. Next group to look at is international income and emerging markets hard currency. We'll cover some of the local currency as well. International income funds for the quarter, they slid a little bit. They dropped about 1.42% as the U.S. dollar strengthened. We'll cover that off in a minute. For the year, they were up about 89 basis points, and not too bad. Completely different story when it comes to emerging markets, where hard currency slid about 3.5% for the quarter. Emerging markets local currency slid 5.5% for the quarter. Both of them had a tough go of it as the U.S. dollar strengthened considerably. So here's the trade-weighted U.S. dollar index, and this is going back 15 years to give you some perspective on how strong this dollar rally was this quarter. This is what it looked like back in 2008 during the financial crisis. It didn't go quite as high, but it's that kind of steepness. If you compare the two areas or 2 points in time, a 9% gain this quarter is a huge rally for the U.S. dollar. And to my eyes, this looks like people are beginning to wonder if shades of 2008 crisis are upon us in some degree, and that's why they're flocking towards the U.S. dollar. Here's hard currency and local currency funds on an index basis going back to the beginning of the year, and I put that next to the U.S. dollar index, which has grown steadily and, again, really took off this quarter. Both types of funds struggled for gains this year. We did end up seeing the hard currency funds with positive gains for the year, up about 136 basis points, but emerging market local currency down about 5.65%. So a tough time to be in the local currency debt funds. And finally, let's talk a little bit about munis here. They had a great quarter. Here we can see on the blue line at the bottom where we've got the end of Q3 yield curve and the end of Q4 yield curve. The darker ones are Q4. So for the most part, most states with a AAA rating saw their yield curves get a little bit flatter, but the long end declining. So a good rally in muni funds there. Overall, we saw muni funds up about 1.25% for the long-term products, not including like the short-term and intermediate. High yield also had a good rally. It was up over 200 basis points for the quarter. Had a fantastic year, though. Up 14% for the year. So high yield muni was really the place to be. Could beat just about any other stock fund out there. Now, note that Puerto Rico had a little bit of a sell-off where its yield curve ended up higher than where it began the quarter. It's still not out of the woods. No one expects it to get out anytime soon. So people were a little concerned about Puerto Rico and sold off that paper. Illinois is the other shoe that we're waiting to drop. It has a lot of problems with its pensions. They're deeply underfunded and they don't have a solution for it. Illinois paper did have a little bit of a rally, but it's still well above a lot of other states with AAA ratings. It's currently at an A- and holding. So here's my outlook. Here's what I said at the end of Q3 and the grade I gave myself. I thought the Treasury curve would be unchanged. That clearly didn't happen. We had a really strong rally in the yield curve. My view for the first quarter is that we'll see the Treasury curve go flatter. Investment grade spreads widened. That happened. I expect them to widen farther. Loans and high yield lost again. I expect that to continue. Frankly, I think that what we have going on right now is going to be in place for at least another quarter. So I'm really not changing most of the views I had at the end of Q3. Emerging market hard currency over local, that will continue. I think local will really struggle for returns in Q1, probably look like Q4 again. And I think munis will outperform. Now, I said outperform and they were up 1.25%, but hey, that's on a non-tax adjusted basis, so you have to give me another 35% on that. So, and that's not cheating. So anyway, thanks for listening. I'm going to turn it over to Pat Keon now.